With inflation on the rise and consumers feeling the strain, is the economy heading for a hard landing?
That's the critical question we will explore today, drawing insights from leading financial experts, including George Gammon and Neil Howe.
Stay with us as we uncover concerning trends in the housing market and alarming predictions about the banking sector. Welcome to Financial Insights in Minutes, your go-to source for concise summaries of significant financial news from around the globe.
This video will delve into essential discussions on economic vulnerabilities, addressing potential recession triggers and pivotal market signals. Indeed, we're also going to discuss unexpected indications from gas prices and what they could mean for consumers.
Let's dive right in. In this segment from Kitco News, we'll discuss looming recession fears and the possibility of a hard landing.
Correct. George elaborates on how the interconnectedness of our banking system hints at a more serious economic downturn ahead, raising concerns about a repeat of the great financial crisis.
So, what's the key argument made by George in this discussion? What does it mean for our economy?
The thesis argues that a hard landing, potentially more severe than previous mild recessions, is likely due to escalating risks in the banking sector and the lasting effects of past government interventions during the COVID-19 crisis.
Let's explore the primary points George discusses about the current economic landscape.
Absolutely. He emphasizes that the interdependence of banking systems creates substantial risks, with banks engaging in riskier derivatives to stabilize their portfolios.
What about the repercussions from the government's pandemic response?
There's significant concern that lockdowns and governmental decisions have caused economic distortions, leading to disrupted supply chains and financial hardships for many.
That is indeed concerning. What does the outlook look like for consumers?
Currently, nearly 40% of Americans are anxious about their ability to afford food, highlighting the financial stress on the average consumer, exacerbated by soaring inflation diminishing purchasing power.
And when can we expect this hard landing to occur?
The New York Federal Reserve estimates the risk of a hard landing at 56% by June of 2025, making it a crucial timeframe for investors.
George has made some bold predictions. What's coming next?
He suggests that the likelihood of a hard landing is increasing, potentially leading to job losses and a reevaluation of economic stability.
What about interest rates? What role do they play in this economic context?
When the Federal Reserve cuts rates, it often signals a response to economic downturns. This could trigger deeper market declines before any recovery emerges.
To summarize, what major conclusions can we draw from George's insights?
In conclusion, George emphasizes the importance of proactive measures as risks grow in the banking system and consumer finances, urging vigilance while navigating these uncertain times.
And finally, what should viewers think about as we face these predictions?
It's crucial for both individuals and policymakers to consider strategies that could stave off a hard landing. What do you think? Share your thoughts with us.
Let's plunge into this topic. Today, we explore vital insights from Neil Howe regarding a potential convergence of financial, social, and geopolitical crises.
Neil's discussion is illuminating as he connects personal and societal trajectories, diving into economic forecasts and social dynamics.
What's the core thesis of this discussion? Are we genuinely heading toward a critical collision?
Absolutely. Howe points out how rising inflation and widening social divides could trigger simultaneous crises across various sectors, a true perfect storm.
What impact does rising inflation have?
Howe notes inflation is crucial. We're grappling with heightened living costs, which destabilizes households countrywide.
How's the political situation affecting the economy?
Political polarization is at an unprecedented level, and Howe warns that regardless of the election's outcome, societal unrest is likely to intensify afterward. What will happen next?
Are we witnessing potential civil conflicts?
Yes. Howe draws unsettling parallels to historical civil wars, hinting at potential tensions rising as younger generations feel increasingly marginalized.
What about our financial landscape?
Howe predicts a financial reckoning is imminent, driven by massive national debt and a looming recession.
And where do we go from this point?
Howe advocates for sweeping reforms to realign economic policies, addressing inequalities before the situation escalates uncontrollably.
What can we anticipate regarding social dynamics?
Howe warns of significant social unrest as people react to disillusionment with political outcomes post-election. What will it take to achieve unity?
And what does the financial outlook indicate?
Financial turbulence looms as intersecting crises could severely impact consumer spending and borrowing.
So to summarize, what's the important takeaway here?
Howe's perspectives remind us of the necessity to actively participate in reforming our policies to ensure stability during these tumultuous times. Challenging choices are on the horizon.
What's the call to action for our viewers?
The time for reform is now, and engagement in the future of policies will shape our community's resilience for years to come.
Thought-provoking stuff. How do you plan to navigate these potential challenges ahead?
We want to hear from you. Share your strategies in the comments below as we tackle these challenges together.
Let's jump right in. Today, we're analyzing the recent drop in gas prices and what that truly means for the economy.
Indeed, while lower gas prices may seem like a win for consumers, they can actually signal concerning economic issues lurking beneath the surface. Buckle up as we explore.
What's the fundamental takeaway from the decline in gas prices?
The essence is that while gas prices have plunged by 15%, this decline hints at troubling weakness in economic activity rather than relief for consumers.
Let's unpack the details, starting with demand. What's the current situation?
Gasoline demand has reached alarmingly low levels, with usage hitting approximately 9 million barrels per day, considerably lower than what we've seen in previous years. Consumers are running out of energy.
What's happening with refining margins?
Margins are plummeting, suggesting that refiners are anticipating even weaker demand ahead. Definitely not favorable news for energy markets.
What does the future look like for the energy sector?
Goldman Sachs has recently lowered their Brent crude forecasts, expecting a surplus even amidst low inventories. The market anticipates a deeper decline.
What long-term effects can we expect?
The likelihood of a recession is rising, as continued declines in consumer spending and inflationary pressures validate these fears.
What about consumer credit moving forward?
With banks tightening credit availability, consumers may face challenges in spending, leading to a cycle of economic decline.
As we wrap up, what are the main takeaways?
Falling gas prices signify more than just consumer relief. They indicate economic strain, worsened consumer saving rates, and foreshadow a looming recession.
Before we wrap, we're curious about your views. What do you think is the primary driver behind these gas price trends?
Drop your thoughts in the comments. Let's dive deeper into this conversation and uncover what lies ahead.
Let's navigate the housing market. Today, we're delving into Harry Dent Jr.'s alarming predictions regarding a potential housing crash.
Absolutely. Dent contends that home prices might drop by up to 80%. Let's take a closer look at his reasoning, as startling as it may seem.
What does Dent firmly establish in his argument? Are we witnessing echoes of the past?
Dent posits that the housing market is on the verge of a significant collapse, reminiscent of 2006, driven by inflated prices and climbing interest rates.
What evidence supports Dent's urgent predictions?
He draws parallels with 2006 when home prices fell dramatically. Currently, we are far beyond normal pricing levels.
What's jeopardizing housing affordability?
Without rising incomes, families struggle to purchase homes, and this upward pricing trend can't be sustained indefinitely.
And if this trend continues, what could happen?
It could lead to significant price drops. Historical market cycles often show patterns where peaks led to severe declines.
Harry Dent anticipates a dramatic decline. How severe will his predictions be?
He believes prices could plummet between 50 and 80%, numbers that suggest an impending crash.
What role do interest rates play in this scenario?
Rising interest rates could further diminish affordability, complicating buyers' entry into the housing market.
What should we glean from Harry Dent's insights?
It's vital to remain aware of market affordability and historical patterns. The stakes are high as we confront potential market upheaval.
Before we dive deeper, what do you think? Is a crash really imminent?
Feel free to drop your thoughts in the comments as we navigate these turbulent waters.
Let's dive into today's trends. We're exploring the latest developments in stocks, gold, and bonds.
Indeed, Craig's expertise will navigate us through this complex market landscape. What should traders keep a watchful eye on this week?
What's the core thesis of today's market update?
The The primary takeaway is that while equities are showing mixed signals, there's potential for gold to rise, along with a robust stock market rebound if specific indicators align.
What insights can you share about the SP 500's recent performance?
The SP 500 recently experienced a spike in trading volume indicative of panic selling, yet it rebounded quickly. If these current levels hold, a sizable rally could be on the horizon.
What about gold's performance this week?
Gold appears undervalued, gearing up for a potential surge. Historically, September often provides favorable trading conditions for gold prices.
What should investors stay wary of?
Investors need to remain cautious of impending market volatility due to potential election impacts. Navigating these cycles will be crucial for success.
What are the anticipated future price targets for gold?
Gold could rise towards 2,650 or even 2,700 if market conditions remain favorable, although short-term pullbacks could still occur.
How is the market positioning for the future?
There's potential for a market reset, creating lucrative buying opportunities for those who successfully navigate these transitions.
To sum up, what should traders take away from this update?
Stay alert. With mixed market signals, opportunities abound, but remaining cautious is key as each data point provides a chance to strategize.
So what's next for our viewers?
Continuous monitoring is key. As trends evolve, wise traders will adapt and capitalize on new market conditions.
As we wrap up, it's clear that experts have varying yet concerning predictions for our economic future.
Absolutely. George Gammon warns us of critical vulnerabilities in the banking sector.
Neil Howe adds that we must consider the intertwining nature of financial and social crises.
And don't forget Harry Dent's alarming forecast on the housing market that has many worried.
Meanwhile, Craig Vermeulen suggests there are still proactive opportunities among these risks.
The key takeaway? It's crucial to stay informed and prepared for possible economic shifts.
If you found this discussion insightful, please give us a thumbs up and subscribe for more financial insights.
Join us next time to deepen your understanding of these pressing issues. Don't miss out.
Thanks for tuning in, and make sure to check out our other content for more valuable discussions.